For most of your life, you have been told that ships move because of supply and demand, because of oil producers and big shipping companies.
That story is only half true. The other half lives in small rooms full of contracts and risk models, where strangers decide which cargoes are allowed to move and which must stay frozen in place. For more than 300 years, many of those strangers sat in London around the marine insurance market that grew up at Lloyd's.
Today, more and more of the power to decide which cargoes really move is shared between those private markets and officials in Washington, whose language is simple: dollar or nothing.
A cargo ship is worth hundreds of millions on paper, but without one invisible ingredient, it is worth less than the rust on its hull. That ingredient is a promise. A promise that if the ship sinks, if a spill poisons a coastline, if a missile tears open its side, someone with deep pockets will pay.
Banks will not finance fuel or cargo without that promise. Ports will not open their gates. Refineries will not sign contracts. With the promise, the ship is an asset. Without it, the ship is a floating problem nobody wants to own. For centuries, that promise typically came from a private market in the City of London. A network of underwriters, brokers, and syndicates took on the risks of storms, pirates, and war zones. They turned danger into spreadsheets and premiums. In doing so, they quietly gained the power to decide which routes were acceptable and which countries were too toxic to touch. When major London-based insurers and reinsurers pulled cover from a port or a region, exports often faltered and economies felt the squeeze, even if no government had formally announced an embargo. No headline said London has turned off the tap, but that was what happened in practice. The most elegant part of this system was its deniability. No one needed to declare an embargo or pass a sanction. Insurers simply adjusted their models and concluded that the risk was too high. Premiums rose beyond what ship owners could pay, or coverage was withdrawn outright. On paper, it was just math. On the water, tankers dropped anchor and stayed there. Oil floated in place while contracts expired and governments panicked. The world got used to this quiet power. It was just how things worked. Then the world started to get more dangerous in ways the old models struggled to digest. Drones hit tankers in strategic straits. Missiles stalked shipping lanes. Mines and proxy militias turned narrow waterways into chessboards. Every time a vessel burned on the evening news, actuaries in London widened their eyes and sharpened their pencils. Risk premia climbed. Some routes became so expensive to insure that the equation stopped balancing. Eventually, for certain passages, the answer was simple: no cover. Imagine dozens of tankers stacked at the mouth of a narrow channel, each holding enough energy to power a nation for days, just sitting still. Each hour they are idle, someone pays penalties. Refineries hundreds or thousands of kilometers away begin to draw down stockpiles. Traders scramble to reshuffle cargoes. Spot prices jump. For households, this shows up weeks or months later as higher bills. For politicians, it shows up as angry voters. For the people actually controlling the risk, it shows up as a line on a spreadsheet and a decision we will not sign. That was the moment when Washington finally realized it was fighting with one hand tied behind its back. The United States could send carrier strike groups, patrol the sea lanes, and fly sorties over danger zones.
It could keep the routes physically open, but as long as the paper that made those routes commercially viable was written in another country by private actors with their own constraints, American power had a ceiling.
You cannot force insurers to write cover by parking a destroyer off their coastline.
So the United States tried something else. It did not try to bully the market into submission. It began building a government-backed layer on top of the private market. Using agencies that had been created to support investments in risky and emerging markets, Washington started to offer something the private sector could not match in certain war zones: sovereign guarantees and reinsurance on commercial shipping. From the perspective of a ship owner with loans to service and crews to pay, the choice was stark: On one side, unsure coverage, volatile premiums, and the possibility that a single incident could leave the company bankrupt. On the other side, a guarantee ultimately backed by the U.S. Treasury.
The missiles and mines did not go away, but the fear of being left alone with the bill did. That difference is enough to send a ship into a gray, dangerous horizon instead of leaving it stuck at anchor, burning money.
This shift did not just move a few ships, it began to rewire parts of the global risk engine. Premium flows and risks that once sat almost entirely in private markets like London's have begun, in these conflict-exposed routes, to pass increasingly through American public institutions whenever private war risk cover retreats. The balance between private and public risk quietly changed. The dollar, already the main currency for trade invoicing and reserves, gained a sharper role in these areas. It became the core of an explicit safety net wrapped around the most dangerous arteries of global commerce. When the issuer of that safety net is a superpower, the pricing and terms of that support can quietly turn into policy tools. If the United States wants to encourage flows along one route and discourage another, it can do more than send diplomats or release statements. By tightening or relaxing the conditions of its guarantees, or signaling that certain flags and counterparties are more welcome than others, it can encourage some flows and discourage others without ever passing a new law. A tweak to eligibility criteria can move billions in trade.
For countries that import large amounts of energy, this is both reassuring and frightening. Reassuring because there is now a powerful actor with both the will and the capacity to keep critical flows moving when private markets seize up.
Frightening because those flows can now depend on political alignment as much as on commercial logic. If your government drifts too far from Washington's preferences, the question is no longer just, can you pay the premium? It becomes, are you still invited under the umbrella? Not every nation is comfortable living under that umbrella. Some, especially those often targeted by sanctions or caught in strategic crossfire, have spent years experimenting with alternatives. They have built state-owned or domestically controlled insurers willing to take on risks Western firms avoid. They have sponsored fleets that operate outside conventional financial channels, handling cargoes that mainstream ports and banks will not touch. They have tested payment systems designed to route around the dollar.
These efforts show that the dollar shield is not the only game in town.
But alternatives come with their own costs. A tanker insured by a small state entity or a thinly capitalized private firm might find fewer ports willing to accept it. Banks may charge more to finance its journey. Charterers may demand discounts to reflect the uncertainty. If an incident occurs, the legal battles can drag on for years. The discount on the front end can become a disaster on the back end. That is why, despite all the talk of de-dollarization and parallel systems, many companies still quietly prefer the big, boring promise from Washington. Taken together, this is pushing global trade toward a new hierarchy. Near the top are the ships, companies, and countries that can count on access to US-backed guarantees or to insurers closely plugged into that dollar-based system. In the middle are players who sometimes qualify and sometimes do not, forced to juggle between different systems and accept occasional spikes in cost. At the bottom are those who are shut out, by choice or by force, paying a permanent premium for the privilege of sailing without the dollar shield. For ordinary people, this hierarchy is invisible but very real. When a factory chooses where to build, it looks at not only wages and taxes, but also the reliability of its supply lines. When a government plans its energy mix, it must now consider not just the technical and environmental factors, but also the political stability of its shipping channels and the attitude of the United States toward those channels. These calculations feed into decisions about jobs, investments, and prices, which eventually land in your inbox and your bank app. There is also a feedback loop inside the United States. Every new guarantee the government extends adds a bit more risk to its own future balance sheet. If global trade remains relatively stable, claims may be rare and affordable, and the program can even generate fees. But if a major conflict erupts or a string of disasters hits critical routes, the bill will come due at exactly the moment when public finances are already under strain. In that scenario, the dollar shield becomes both a strategic asset and a fiscal vulnerability.
So we are left with a paradox. The more the world depends on U.S. guarantees to keep trade moving, the more power Washington has to shape economic outcomes far beyond its borders.
At the same time, the more guarantees it issues, the more tightly American prosperity is tied to the smooth functioning of a world it cannot fully control. The shield protects, but it also binds. It is both armor and leash. Where does that leave you? You cannot vote on the terms of a shipping guarantee or sit in on a risk committee in Washington.
But you can understand that behind every sudden spike in prices, every shortage on a store shelf, every news story about a disruption in global supply chains, there is usually a story about risk and who is willing to carry it.
Increasingly, that story has dollar signs stamped all over it. In the coming years, you will hear a lot of grand phrases about a multipolar world, strategic autonomy, and de-risking.
Those debates will matter. New systems will be built, old ones will resist. But underneath the speeches and slogans, one quiet question will decide more than most. When a ship leaves port, heading into uncertain waters, whose promise is written on its papers?
If the answer is the United States, then the world will continue to live inside the dollar shield, enjoying its stability and worrying about its strings. If the answer becomes more fragmented, then trade may grow more chaotic, more regional, and more expensive. Either way, the era when risk was something a handful of specialists in London could price in peace is ending. We are entering a time when risk is openly, nakedly political.
Dollar or nothing, it is not just a catchy line. Especially in crisis-prone routes, access to dollar-backed insurance and guarantees is becoming one of the quiet sorting mechanisms of global trade. The real question is simple, and it will not be decided in a classroom or a comment section. When the next crisis hits and the next route freezes, will you be inside the shield, paying for its protection, or outside it, paying for its absence?